I'm Nate Lind, and I help people interested in buying or selling online businesses get the transaction done without the deal falling apart. If you're looking to buy or sell online businesses, then be sure to keep tuning in for more videos like this one. Be sure to subscribe and hit the bell for notifications about new videos and interviews. And introduce yourself in the comments. Are you a buyer or a seller? Hi everybody, Nate here, and I've got a very special guest, the know-it-all about SBA lending. I've got Steven Spear here from Ecom Lending, and most of our successful transactions using SBA lending run through Steven. And wanted to bring him on and talk a little bit about the basics of SBA. This is a fantastic video if you're selling your business and you think it might be SBA approved, or if you're buying a business and you want to use the SBA to help finance the acquisition of it. Steven, why don't you give us just a 30-second intro to yourself, and let's dive right into the basics of SBA lending.
Sounds great. Thanks for having me on, Nate. My name's Steven Spear. I'm CEO and founder of e-commerce lending. And we've done over $300 million worth of funding in the space, over 325 transactions, a lot of nuances to online business acquisition financing, and I think that's where we shine. We're specialized in it. We've helped many, many buyers obtain businesses via SBA financing, and thanks for having me on again.
Yeah, absolutely. We've got your screen up here, so let's just roll through this. Go ahead and hit the first one. What is SBA financing?
So one thing I need to kind of make note of, and a lot of people think the SBA is actually doing the lending. They don't lend money. They're simply the insurer of a loan. So what transpires is a lender, is able to lend you money with a loan that happens to be guaranteed or insured by the SBA. That's all that is. It's not where the SBA is actually doing the lending. They're not doing the underwriting. They're simply the insurance company of the loan.
It's kind of like Fannie Mae or Freddie Mac for the real estate world. They're not the lenders. You're still getting a loan through Bank of America or Wells Fargo, but they're providing the insurance behind the scenes.
That's exactly right. So that's a little bit of a lot of people think it's actually SBA doing the lending, and they don't lend money. So that's one thing I wanted to make clear. And so in this space, though, what are your options in acquiring a business? Really, first and foremost, paying cash, either with your cash or somebody else's. And the other option is through debt, through a loan, and it's going to be an SBA loan. Why are SBA loans the only loans available within the space? It's because within the space, when you're acquiring an online business, there's really no there. There's no tangible asset. You're not buying a building. So with that, the lenders, want to be insured on the downside, and without that SBA insurance policy or guarantee, they're not going to be lending the money. So really, again, paying cash or obtaining an SBA loan. So, and obviously that's something we can help you with. So that's what SBA financing, and that's why SBA financing is so prevalent in the space. So who qualifies for an SBA loan? It's, first off, a couple of things. SBA loans are available to U.S. citizens or permanent resident aliens, AKA green card holders. So they're not available to essentially foreigners, unfortunately. And then, so there's that side of it. And then in terms of what businesses may qualify for SBA financing, they need to be U.S. domiciled businesses filing U.S. returns. There's no, even though the business might be overseas, but selling its wares, let's just say Amazon here in the United States, it doesn't matter. The business itself has to be a U.S.-based business. So those are two things that must be in place to move forward on an acquisition. So those are the two things. There's, in terms of the pieces of the puzzle, we first try to determine, does the business itself qualify for financing? What are some of the things we look at? Well, we look at the historical earnings of a given business. That's really important because oftentimes a lot of these businesses have a really short, what I call runway. and they've done great in the last 12 months. Their trailing 12 months is great, but historically it might not be adequate. Might not be enough historical earnings of that given business. And that's something we'll be able to determine as you continue your search. We'd like to see a business around at least 2 full tax years. So right now we require, let's just say 2019 tax returns, 2020 tax returns if they're done already, and then obviously a year to date, and we're only through the end of January here in 2021. So we take a look at that, and based on those historical earnings, does the business generate enough cash flow to service the proposed loan if you were to buy the business? And that's something we look at to be able to make that determination. We also look at other things. Is a business selling something that's going to be around? Is it a viable business, or is it kind of a trendy product? If they're selling fidget spinners, it's going to be really tough to get financing if it's something very trendy. We also look at number of SKUs and how many, what percentage of sales are any given product of the business. And then on the service side, obviously, on a service-based business side, like a SaaS business, we look at, the continued, we look ahead and determine if, the viability of the business moving forward in that area as well. And then from a buyer standpoint, what are some of the things we look at? Well, first, in working with us, we'll require you to complete a personal financial statement, along with kind of a buyer's questionnaire that really helps us get a general sense of the buyer's profile. So those are 2 things we look at, along with a consultation that I perform with buyers. And we look at personal liquidity. Does the person have an adequate funds to acquire business at his targeted price point or her targeted price point? And we look at business acumen. Does the client's business acumen match the size of business he or she wants to acquire? And the reason that's important is that if you're looking at a $5 million business, but you don't have the personal liquidity or the right skill set business, then that's something that we'll probably note during our conversation, say that that's great, but that you're looking at businesses at 5 million or 4 million, but really based on your personal liquidity and your business acumen, really you should be looking at 2 million instead. So those are some of the things we do during our consultation phase up front. So when our buyers go to search for businesses, they know, A, they're pre-qualified for a certain amount, and secondly, they're not looking at businesses that they're never going to qualify for and waste everybody's time. So those are some of the things we look at. And in terms of credit, we ask that question. We don't run credit, but we do ask that question in terms of what the person's credit score is. Most people have a good sense of what that is, but we look at that as well.
And it will be run before the loan is done and the business is acquired, right?
Yes, it'll be run further down the process. With all the credit laws out there, lenders are really having to delay that part. But yes, we'll have credit run generally, typically a couple weeks after your LOI is accepted, and we're pretty far along down the loan phase of the transaction.
And what are some red flags on credit? What are some automatic denials?
Any recent bankruptcies? Now there are, I won't say a fair amount, but there are the occasion where we've had clients declare bankruptcy, but it was during the 08, 09 situation, which, enough time has passed. It was a one-time occurrence where, as we all know, that was a world of hurt back then. But we've even had clients, file recent bankruptcy, and that would be completely disqualify somebody from acquiring a business, unfortunately. So we look at that, and we look at judgments or collections and those sorts of things. We do ask those questions, and most of our clients are very honest in those areas, but at least we're able to address any potential issues up front.
Yeah.
We don't want any surprises down 6 weeks down the path.
Yeah, it's important for anyone watching this that if that sort of a situation may be uncovered, just you need to talk about it, because you're not going to sneak through. It's just not going to happen.
And most people, again, are pretty honest. They'll tell us up front, and we can kind of navigate through it. Some people are thinking it's just they're never going to be able to buy a business because of some credit blemishes in the past. But in most cases, we're able to work through them, and at the end of the day, be able to finance our buyer clients. So those are some of the things that I wanted to bring up. Unlike when you go to, let's say, acquire a home, where it's does the buyer qualify? Really, in the business acquisition area, it's both, does the buyer qualify and does the business qualify? And what we do is, once our buyer's pre-qualified, as that person looks at businesses to acquire, we're able to help determine if any given business that does pique his or her interest, to make sure the business itself qualifies for financing. And that's something we do multiple times a day for our clients. So, and then in terms of qualifying, SBA loans are able to borrow up to $5 million. And that could be for one deal, that could be for several acquisitions. And that question comes up a lot, Nate, where people think it's, they're not able to have multiple SBA loans. You are allowed, and many of our clients, as they build their portfolio of businesses, they have multiple SBA loans. That's perfectly allowed, as long as the $5 million threshold's not breached.
Yeah, I've got a deal going on right now where a buyer's looking to acquire a $2.5 million, $2.9 million business, and he's already used 2.5, and so this will just be his second loan.
And that's a perfect example, and so take advantage of it. I mean, the financing's generally very leveraged, which is good. SBA has its strengths and some weaknesses, but overall, I mean, there's a low barrier to entry within SBA financing. It allows for fairly high leverage. Doesn't require any collateral, which is enormous. So most of our deals, up to about $1 million, are done with just 10% down payment or equity injection. So if you have, as you know, Nate, a lot of these businesses are growing at 20% year over year. Well, with a $100,000 investment, our buyer clients are getting 200% return on their money. I mean, where are you going to get 200% return on your money? I mean, you're just not. So, and a fair amount of our clients could actually pay cash for the $1 million business, choose not to because they look at return on investment. So they'd rather use $100,000 of their liquidity as opposed to $1 million of the liquidity. They get pretty substantial returns on that money.
So a comment for buyers listening to this: if you're in that situation, it's really important you make clear to me as the broker that is a possibility, because you're setting yourself apart financially from many other buyers. If I know that and I'm confident about that, if you share a personal financial statement or share a brokerage account screenshot with me or something like that, that immediately moves you to the top of the pecking order of buyers interested in these businesses. Myself, other brokers at Website Closers, and any buyer that's in a situation like that would much rather work with someone like you than someone who just barely has the liquidity to get the deal done.
That's a really good point, Nate. So, and again, it's all about separating yourself from all the other buyers, and that's something that can be a differentiator. So once as you continue research, you figure just in your mind about 10% equity injection or down payment up to about $1 million. As you move up in price point, even though the SBA only requires a 10% down payment, lenders have what I call overlays. So if you're buying a $3 million business, chances are you're going to be required to at least put 15% of your own cash into the deal. And then you could also work in seller notes. They're very commonplace above about $1.5 million price point, as probably as you know, Nate. So, depending on the acquisition, we're able to, all of us to work together in finding the best structure that'll not only meet your requirements as a buyer, but be able to, appease the seller, because ultimately the seller has to accept your offer. And then we put everything together. Once your offer is accepted, then you're going to run kind of two rails. You're going to run your due diligence rail with your due diligence team, and additionally your loan rail with your lender. So those happen simultaneously. People think that, well, I'm not going to start the loan process until due diligence is over. Well, a seller's not going to wait around that long. So that's why both rails have to happen simultaneously, right?
Yeah, and I need to see the pre-approval letter before we'll accept an LOI. If you're going down that path, we need to see that. Prefer it be with the lender that was pre-approved for the business. So if it's an ecom lending, pre-approved business, you need to work with ecom lending to get the pre-approval letter. I need to see that Steven's done the liquidity check and that sort of stuff so that you're qualified. LOIs won't get accepted without it.
That's a really good point. So that's one thing we provide to our clients, is that we get them pre-qualified. We provide them with a letter, and usually that process takes about a day. But you'll have a letter. You'll be able to submit your LOI with the letter. And again, that's separating you from all the other offers that are potentially on the table. So, and then as you run these two rails, timing, how long do things take? Generally, the process takes 60 days, but it is predicated on you, the buyer. We have some deals that close in 60 days. We have some deals that close in 60 years. I'm kidding. Ultimately, lenders can't submit your loan for approval until they have everything from you. So it's really up to you. It's almost like working with an accountant when it's tax season. Your accountant's not able to move forward on your taxes until he or she has everything from you. Well, same goes on the loan side. We require everything up front to be able to move forward in obtaining your financing. So what are those things? What are the things that we're going to require? Well, your tax returns, asset statements, the typical stuff. I think the only things that are kind of out of the ordinary that you might not be aware of is that when you obtain a loan for a business acquisition, you're required to put together a business plan and projections of that business moving forward. So that's something that's might be new to you, but that it will be a requirement and will help you through the process. We have very good templates that our clients use to walk you through the business plan and projection phase. And another thing that's unusual is with SBA loans, you'll be required to get a life insurance policy that in case of your death, essentially the loan is paid off. That's a little unusual, but that is a requirement. And we're able to really set the stage for you right up front in terms of that. So just follow our lead and we'll be able to help you through that. And then just in general, one of my notes is larger purchases. Yeah, there's more scrutiny. There's more risk for a bank. Right now we have a $6.5 million acquisition, which is about a $4.8 million loan that we're working on right now. And underwriting is going to be more scrutinizing than a $400,000 loan. So, which makes sense. And also they're going to look for, underwriters going to look for more business direct skill set and the higher price points and maybe something sub $1 million. So those are all the things that lenders look for in determining if they're going to approve your loan or not. And we have a good sense here at e-commerce lending what deals get approved and what deals don't, and we have a good track record and the fact that over 97% of our deals get approved ultimately. So, and in terms of SBA loans, what are the rates? What are the terms? For business acquisition, it's always a 10-year loan. So there's no like 7 or 5. It's not like we're maybe a home mortgage where you're able to pick, have 2 or 3 different options in terms of your term. It's always a 10-year loan. And the rate right now is 6%. It's like dirt cheap.
Wow.
It's the lowest I think it's ever been. Yeah. So, and what can be incorporated into that loan? So you have obviously your acquisition. And if you're buying a product-based business, we're able to work in the inventory that the seller will be selling to you. And then we always try to build in some extra capital for additional inventory once you close. And as well as working capital. We want to have you in a position where you have enough quote unquote dry powder as possible to be able to continue to scale that business. The last thing we want is overcommit your liquidity towards an acquisition and end up running out of inventory. We want to keep you as liquid as possible as you continue to scale that business.
Let's talk about that for a second. So, Stephen, if someone has 10 or 20% to put down on a business, is that all the liquidity they need?
On a product-based business, we look for at least 8% of what's called post-closing liquidity. So, for example, if you're buying a $1 million business, we look that you have at least $80,000 left over after closing in post-closing liquidity. So it's not just the dollar, let's just say the $100,000 to acquire a business. We're going to look to make sure that you have additional funds and reserves to continue to grow that business.
So on like a business under $2 million, they might be able to get a 10% down payment, 10% down payment, and then 8% post-close liquidity. So they really need 18%. And then I think when it's over $2 million, right, usually it's more typical that it's a 20% down payment. And then also, is it 8% post-close liquidity?
Still,
yes. So then it's kind of like a 28% down payment, so to speak, or 28% liquidity calculation.
Liquidity metric, yes. We'd like to see that. And with SaaS businesses, it's going to be a lot less than that because obviously you're not dealing with inventory. With SaaS businesses, it's maybe 23%. It's additional 3% post-closing liquidity.
Got it.
And when I say post-closing liquidity, I don't mean like retirement accounts. I mean like liquid. But that's something definitely underwriters look for. A lot of people might not be aware of that, but it's not just the entry fee. You got to have something left over afterwards.
Yeah, I've had several people reach out to me and say that they have like the barest minimum to qualify and that they're looking at this business. And I'm sorry, folks, it just doesn't work that way.
Because, I mean, the kiss of death is, as you can, relay to your audience, Nate. I mean, how does the business do once it runs out of inventory? How does that?
Not good at all.
Yeah. So that's one thing we avoid like the plague. It's happened to a couple of our clients in the past, and it was definitely the parade of the horribles. And that's one thing that we try to avoid that happening, not only through upfront vetting of the buyer, but also being able to secure additional working capital to make sure that never happens.
Very good. Stephen, any other comments you've got about the basics of SBA?
I think another key point seller notes are, although they're not required, oftentimes they are part of a deal, especially above about a $2 million threshold. Seller notes are pretty common. So what does a deal might look like? Well, it might be 10% from you, 10% from in form of a seller note, and an 80% SBA loan. That's pretty common, depending on the price point. But that's seller notes are fairly common, and that might not be familiar to you as a buyer, but it's not out of the ordinary at all.
And that seller note is going to be subordinate or in second position behind the SBA loan. So if there's
Correct.
A default situation, the SBA gets first dibs before the seller does.
That's correct. Yes.
Can you break down the debt service ratio? Like, help us kind of understand that, because after someone closes on a business, obviously the cash flow of it is obligated to the SBA. Can you help us understand a little bit more about that?
Certainly. So one thing lenders look at is what's called debt service coverage ratio. What is that? What do these fancy words mean? It just means that we look at historical earnings, and let's just say we calculate based on this acquisition that your overall annual loan payment is $100,000 for easy math, 100 grand. We make sure that the net number of the business, like the SDE number with all the add backs and everything, it is at least $115,000 SDE. So $100,000 loan payment, we would need to reflect at least $115,000 in SDE, seller discretionary earnings, in order for that business to qualify for financing. That's like bare minimum. Obviously, higher price point, you're going to have certain underwriters, you want more than just the bare minimum of what's called 1.15 or 115% debt service coverage ratio.
So this is kind of like, again, going back to real estate, like when you buy a house, a traditional number is only 30% of your income, debt, kind of debt ratio applies towards your mortgage payment. So if you're making $100,000 a year, you would only be able to afford up to a $30,000 a year mortgage payment. Is that kind of how you calculate this?
Yeah, I mean, in essence, that's what it is. The difference is that the business that you're acquiring has to make that has to make that payment. So that's what we look at. Does the business have enough historical cash flow to make that loan payment?
And we've already,
regardless if you're able to.
And we've already figured this out by the time the listing goes live, because we pre-approved it. You've detailed that in the pre-approval letter. If it's one of my listings, that's in the Google Drive I provide in the with the offer memo and the financials and stuff.
Exactly, and that's one thing that you do that perhaps some other brokers don't do, is that you are wise enough to have your businesses pre-qualified. So when you do go to market, buyers will know that business qualifies for financing, and also from a marketability standpoint for brokers, you just quintupled your buyer pool by being able to offer that financing, and also just having that earmark that it is SBA pre-qualified makes it a lot easier for your buyers to know which businesses to really pursue and which ones won't qualify or don't qualify for financing.
Yeah, it's a two-edged sword. I get so many responses when I do that it creates a ton of work for me to figure out, who's still the most qualified buyer, because it doesn't necessarily mean that you can, if you just meet the bare minimum requirements, that you're going to be an attractive buyer to the seller. Again, that's why I mentioned earlier, and I'll restate this, the ways to set yourself apart from other buyers. And when this happens, you're competing with 100, maybe 200 other buyers at the same time. And a way to set yourself apart is be transparent about your liquidity. Be transparent about your acquisition capability, your acquisition experience. Have you done other deals before? Do you have money? How do you strategically fit with the listed business? What strengths and skills do you bring to this business that can show credibility and confidence to the seller that you can successfully transition this business to your control and be skillful at growing it in the future.
That's a really good point. Ultimately, the seller is not going to sell his baby to you if he doesn't have a very strong feeling that the business is going to be viable moving forward. And there's also a likability factor. What's amazing, a lot of our clients, I tell our clients before they have a call with the seller, is you got to be likable. Nobody's going to sell his business or her business to somebody they don't like.
Yes.
So be likable.
Yes. Be kind. Be generous. Be likable. Be affable. Don't be demanding. Don't be needy. Don't be desperate. Don't be frustrating. We at this level of business and M&A, we choose who we want to work with. And we do not choose to work with jerks. That just does not get the deal done. When buyers come in, hard and heavy and fast and start making demands from the get-go, they go right to the bottom of the pile because we don't have time for that.
And that's a really good point, and that's some of the things that really are different than just buying a house. I mean, you're buying somebody's business that, in most cases, he or she started from scratch, and they're not going to sell it to somebody they don't like. And that's something that buyers really need to keep in mind as they get a dialogue going with the seller.
This has been super helpful. I really appreciate it, Stephen. Any parting comments, wise words of wisdom that you would share with sellers or buyers of online-based businesses? As you know, that's what Website Closers primarily represents.
For the buyers out there, I recommend getting pre-qualified. So feel free to reach out to us. You go to our website, ecommercelending.com. And in sellers, as you and Nate prepare for your exit, even if it's 2 years from now, definitely prepare now. Make sure your financials are in good working order, because at the end of the day, your business is only worth how good your financials reflect. And don't commingle businesses.
No, I would recommend every business owner have a holding company that owns your e-commerce business or your digital agency, and keep all of your non-related business expenses up in the holding company, not in the e-commerce entity. Keep the e-commerce entity or the digital marketing agency, SaaS, tech, etc. Keep that super clean. If you go, if you're going to masterminds, or you're taking like really interesting, what maybe later you want to try to convince a buyer is an ad back, let's avoid that whole conversation. Get the tax write-off in your holding company. Keep all that malarkey out of your actual operating entity, which is working, the e-commerce side of stuff. And keep the books clean. For crying out loud, that's going to help us sell you so much faster, instead of having business consulting revenue in the entity that you're doing e-commerce. And then if you're doing stock trading and other, stuff like that, just like move all that up one level. That higher level entity can own 100% of the LLC that's the e-commerce entity. And you'll save all of us a ton of trouble later.
And it'll pay dividends. You'll get more for your business with the cleaner your financials are, the more you get for your business, period.
Absolutely.
So
great. Thanks for joining me, Stephen. I know you're super busy. For those of you that are watching, I would absolutely encourage you to reach out to him. If it's an SBA deal that I'm running, you'll definitely see him involved in it. Thank you very much again, Stephen. I appreciate your time. Thanks for watching. If you liked this video, be sure to subscribe and tell me what you thought about it in the comments. Your comments encourage me to continue posting videos, and they give me ideas about what to post next. I read and reply to every single one. Also, if you own an online business and you're curious of how much it's worth, click the link below to get a free business valuation with a member of our team. Who knows? It may even be me you're talking to.